G'day guys, Seeney here and welcome to another episode on the Australian Wealth channel. And today we're going to be having a look at how I value a growth stock. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. I absolutely mean it. So in this video, we're going to be having a look at how to value a growth stock. So there's a lot of different ways of actually valuing companies, whether it's a growth stock or whether it's a value stock. In this particular video, I'm going to be talking about how to value a growth stock. So a company that's growing incredibly fast. So now the most important thing is when you're looking at any investment, make sure that you're doing your own due diligence and your own research. I'm not a financial advisor. You shouldn't be taking this as gospel. This is just entertainment purposes only. And so you've got something where you've got like a starting point. But if you're looking at investing, then you obviously need to do a lot of your own research and learn from a lot of different sources. So to start with, the first and I believe the absolute most important thing when you're looking at picking a growth stock and valuing a growth stock is looking into a business that you completely understand. Like as in you could basically build the business yourself from the ground up. I think that this is incredibly important that you understand all the factors that are at play when you're looking at investing in a business. And if you don't do this, you're basically setting yourself up for failure because you're unsure of some of these other potential problems that could be occurring with the business. So when you're doing this, it's really important to make sure that you know exactly what's going on and how they make their money, how they generate revenue, what are the risks, what are all of the costs associated with running the business. You basically need to know it inside out. And if you don't, then you either need to do a lot more research into the business or into the sector and how they make their money, or it's just not an investment for you.
Do it! Just do it!
I think this is incredibly important and it rules out so many different companies for me. For example, I think Palantir is a fantastic company. However, it's not a company that I can invest in because I do not fully understand how they make their money. I do not fully understand their strategy and basically how they collect data and use AI. If I could build that AI, then perhaps it's a company that I would invest in, but is definitely not something that I can do. So that's an example of a great company which has a heightened level of risk for me because I don't fully understand the business. However, if it's a field that you're very familiar with, then you have a greater understanding of that, then you can completely understand what's going on there. And I believe personally that this is incredibly important for a number of different reasons, but it means that you'll probably get much better gains than the general population. Warren Buffett, for example, says that index funds are a great way to go. And for people that just want to have money put away every single week and have that grow over time, that's a fantastic option. And what he has said is that diversification is just a protection against ignorance. And it's so true. If you fully understand what is going on with a business and you are not ignorant at all, you do not need to diversify. But if you're someone that just wants to see money grow over time, then diversification protects you from getting into a bad investment that you didn't fully understand. So it's excellent advice from Warren Buffett there. Now, the second thing that I'm looking for when I'm looking at a growth stock is I'm looking for a massively growing business in a massively growing sector. Now, it's really important that these two things line up. You might have a massively growing business, but it might be in a declining sector. Not such a great investment, I personally think. And it could be vice versa as well. You might have a business that's in decline in a massively growing sector. Also, probably not a good idea. I want both of these two things to marry up. So, how important is the sector going to be in the future? That is something that I'm looking at. So if we're looking at some of my investments, they're in e-commerce, cloud storage, plant-based foods, cybersecurity. These are all industries and sectors that are going to continue to grow over time. They're going to become more important in our lives, not less important. So when you're looking at choosing a growth stock, it's very important that you're looking at these sectors that are going to become more crucial to our existence over time. So when you find a strongly growing company, it's important to assess what their moat is. How easy will they be taken out by a larger competitor? What is their competitive advantage? Can they do something that no other company can do? Do they do it better, faster, cheaper, or do they just have the ability to do something which no other business can do? These are all things that you need to take into account when you're looking for a growth stock. So now we're going to have a look at the metrics to actually value the business. So there's a few different ones that you can use in conjunction with one another because not a single metric is going to give you the entire picture. So it's really important to take into account that there's a lot of different things that you can use to value a business. And of course, when you have a deep understanding of this business, you'll understand how these interrelate based on the sector. So the first thing that I normally start with when I'm looking to value a business is, of course, the growth rate. Now, I like to look at this year over year. Some people will do quarter over quarter. I prefer to go year over year as it provides a much larger picture on a seasonal basis. You know, some quarters might not be as strong as others in the particular year, but year over year, you get a much clearer picture of what's going on. So when people talk about the growth rate, they're pretty much always talking about revenue growth unless they specify. So we want to see that this is consistent, not going down too much. Obviously, as businesses continue to scale up, economies of scale, the growth rate can decline a little bit. But if we're seeing an acceleration of the growth rate, then that is something that is really positive. So if we take a look at some of my investments, CrowdStrike year over year has a revenue growth rate of over 90%, Tattooed Chef over 60%, Dropbox 15%, and Coinbase has just had a 900% year over year revenue growth. So some of these are very fastly growing and some of these are not growing as fast, but they're still considered growth stocks. If you're looking at companies like, say, Coca-Cola or Pepsi, you know, they're probably going to be seeing like 1 to 2% growth a year. It's not very large compared to some of these other ones. So growth stocks, basically anything over 10% revenue growth. So if you jump onto Google, you can generally see all of the growth rates of these different companies, and you can look into these particular companies, and maybe it's a sector you know a lot about, and you'll have to probably go through a fair few to find the right growth stock for you. So another metric that we look at is the forward price to earnings ratio. Now, the forward price to earnings ratio, the forward PE, is a good one because it's what's expected in the future, and the market is always forward looking. The market doesn't look back in time. It's always trying to predict what's going to happen in the future. So using the trailing 12-month PE or even the current PE is not looking at the future. So I don't tend to use those metrics. I'll be opting more for the forward PE. So the price to earnings is the stock price divided by earnings per share. So you can find this information on Google. If you're looking into a particular company, it will have the stock price online, and it will also have the earnings per share of their last earnings report. So this can range from anywhere from 0 to $1 million. You know, the price to earnings. So you have your stock price divided by earnings per share, and that's going to give you a figure. The market, I believe at the moment, is roughly a forward PE of around 20, 22. I'm not 100% sure, so don't quote me on that. I've been looking at individual companies. So if something is well below that, then it could potentially be a deal. With growth stocks, that's probably not going to be the case. If they are a profitable company, they'll have a price to earnings ratio. And if that, like for a growth stock, that's probably going to be, 25, 30, 50, 100, depending on the growth rate of the company and how undervalued or overvalued it is. So most strongly growing companies will have a PE ratio anywhere between 20 and 100. You'd be expecting a very high growth on the top end of that. We're talking like a CrowdStrike where it's growing revenues 90% a year. If there's a company with a forward PE ratio of 100 and it's got like 10% revenue growth, personally, I'd be running for the hills and not touching that one. So as a ballpark figure, I'd be expecting a growth rate of at least 15% for a forward PE of around 20 to 25 and a growth rate of 50% or more for a forward PE of around 50 to 60. That's a rough metric that I would tend to work off. So something to note is that if a company is not profitable as of yet, so this is a lot of growth companies in fact, this metric is definitely not the best, because if there's no earnings per share, if they're negative, then this metric is just not going to work. But never fear, we have a few other metrics that we can use in this instance. So In this case, if a company is not profitable, which some of the companies I hold are definitely not profitable at this place, at this stage, because they're trying to put as much money back in the business to scale up as fast as possible. It's a very common tactic. We've seen it with so many different companies around the world. It's basically the playbook at this point. So in this case, I look at the growth rate relative to sales. So this is the price to sales metric. So it's a great metric to see how expensive a company is that isn't profitable, as it's basically done on a revenue basis alone. So to work out the price to sales, you need to take the market capitalization and divide by total revenue. So what that means, the market cap is basically what the company is worth. If you're looking to buy the entire company, let's say it's $2 billion, then the company would be worth $2 billion. And then you would divide that by the total revenue. So let's say the company has $200 million in revenue, it will be 2 billion divided by 200 million, and that is going to give you a figure. So if company A is worth $10 billion and their revenue is $2 billion, you would have a price to sales ratio of 5. So whether this number is cheap or expensive depends not only on the company, but also on the sector. So it's very important to factor in the growth rate of the company, but also the sector. So this is really important to note because different sectors will have different average price to sales ratios. For example, construction companies have massive revenue turnover, but having said that, this can only lead to modest profits, or sometimes they might be losing money. So this metric is a great one, but it can be deceiving based on the different sectors. So it doesn't paint the full picture. So it's just one metric amongst many that you should use. So for this reason, different sectors have different averages in the price to sales ratio. So for example, beverages, if you're looking at a growing beverage company, the price to sales ratio is 4.32. That's the average at the moment. Whereas life insurance, for example, is 0.74. So you need to be really careful of this. You might think you're getting a great deal based on an average price to sales ratio. Oh, it's only 1.5, whereas the average might be significantly lower than that. So you need to take that into account, and it all comes back to knowing the sector. The reason for this is because their margins are vastly different. So margins is another thing that is incredibly important to look at when you're looking at valuing a growth stock. If a company's only got a 2% margin, that they're only making a 2% profit off what they have to outlay, then this is considerably worse than a company that has a margin of, say, 30%. And this is the difference between, say, a beverage company and a life insurance company, is that the margins are significantly better for life insurance. So as a result, their price to sales ratios are going to be different, and they're going to be valued really differently. So look at a sector, see what the average price to sales rate is, and then the average growth rate in that sector, and then you can determine whether something is being undervalued by the market. But of course, you need to take into account the growth rate of that particular company. It might be incredibly high compared to the sector, and that's obviously going to command a larger price to sales ratio. So if something is being undervalued by the market, once you see that, you need to ask why. Why is it being undervalued? What are the risk factors there? What could go wrong with this company? Do they have a customer concentration where they get most of their revenue from one person? Could they become irrelevant overnight? Could they be replaced by another company really quickly? These are all crucial questions that you need to ask. It all comes back to the moat of the business. So having said that, some companies are expensive and they've always been expensive. Now, the reason for that is because they're absolute beasts. So if we look at something like, say, Amazon, this is a great example of this because they've never really been at a good price in terms of the stock price compared to what they're doing today. So there has been some periods in time where it's been attractive, take the tech bubble, but for the vast majority of Amazon's existence, they have been a massively overvalued stock. But you see, if you invested in Amazon back in the 90s, you have been making absolute bank. We've just seen what that stock price has done over time. And it's because they're just a fantastic company that continues to execute. So you might need to pay a premium for some of these growth stocks because the market is forward-looking. They're looking at what these companies are going to do in the future, so they're pricing in future growth. So if you've got a company that's only going to be growing 1% a year versus a company that's growing, say, 30% a year, but they have the exact same numbers, but things are going to change in the future, then the company that's going to be growing at 30% a year is going to have a vastly higher valuation than a company growing at 1% a year, provided that everything else is the same. So you might need to pay a premium for great companies. So just be aware that there's also risk attached to this. There is also downside when a company is expensive. So it's something else that you need to take into account. So there's a ton more ways to value companies, but having said that, these methods are pretty clean. You know, they give you a pretty clear indication of what the company is actually doing. They can't really be clouded too much by shares getting diluted or anything like that. You know, you've got your revenue, your sales, and your size of the company. So it's pretty clean cut, but of course you need to take into account a lot of other metrics. I don't want to go into too many others. I think this is probably the easiest way to value them, and it's how I go about my approach for investing. And so far I've seen some excellent results. But you know, things change in the future. You never know. The market might be on a downturn for the next couple of years. So I just continue to dollar cost average into a lot of these companies at a price where I feel it makes sense for future growth. So you really have to think, if you were to buy a whole company, if the market capitalization is like $2 billion or $10 billion, and you want to buy the whole business, what are you actually getting for that price? What is it that you're actually getting? So you need to have a think about that. That's definitely the approach that Warren Buffett takes, is he thinks about the business as a whole. What am I actually getting when I'm buying something for $40 billion, $100 billion? So I reiterate to finish, you need to completely understand what this business is before you invest. Not a little bit, not somewhat, you basically need to understand everything. And that way, you'll be confident in your investment when the price dives. You'll be excited to buy more. You know, you won't freak out and think,
oh no, have I made a terrible decision?
You won't feel that because you'll know exactly what's going on and you'll think it's strange, which is exactly what happened to me with Tattooed Chef. I deeply understand how that business operates. And when the stock dived around to $16 a share, I was buying incredibly heavily. And now we've seen that the price of that has gone up significantly. And of course, there's been some great rewards there. And I feel that one's got to continue for me. So thank you guys so much for watching. I know this one was a bit of a longer video, but you know, getting into valuation is such a challenging topic. You know, it's really hard to nail that down and simplify. So I thought a bit of an extended video would make a lot more sense for this one. So please make sure you like and subscribe. Really helps to get these videos out to more people. You know, maybe we'll have a look at how to value a value stock, and price to earnings is a lot more important when it comes to that than price to sales. But thank you guys so much for watching, and we'll see you later.